If you have money in savings, you're losing money right now. A classic that always works to educate and attract beginners. I watched my grandmother cry when she opened her bank statement last month. Not because she lost her money, but because she finally understood she'd been losing it slowly, invisibly, for the past 20 years. She had done everything right, everything the old generation told her to do. She saved diligently, never touched her savings account, watched that number grow month after month. And yet, when she tried to buy the same groceries she bought 5 years ago, her money bought half as much. That's when it hit her. That's when she realized the truth that nobody wants to tell you. Your savings account isn't protecting your money, it's watching it die. And the worst part? You probably don't even know it's happening to you right now. Every single day you wake up, check your balance, see that number sitting there looking safe and comfortable, you're actually getting poorer. Not because you're spending recklessly, not because you made bad investments, but because you trusted the one place everyone told you was safe. The question isn't whether you're losing money. The question is, how much have you already lost without even knowing it? And how much more are you willing to lose before you do something about it? Let me paint you a picture that's going to make your stomach turn. Right now, in this exact moment, inflation is sitting somewhere around 3 to 4% annually. Some months it spikes higher, some years it settles lower, but let's be conservative and say 3%. Your savings account, that beautiful safe haven where your hard-earned cash sits waiting for emergencies, is paying you what? Maybe 0.5% interest if you're lucky. Some of the big banks are paying 0.2%. Let that sink in for a second. You're earning 0.5% while your money is losing 3% of its purchasing power every single year. That's a net loss of 2.5% minimum. Now you might be thinking, 2.5% doesn't sound that bad. It's not like I'm losing hundreds of dollars. But here's where the math becomes absolutely brutal, where the reality starts to creep in like cold water, seeping into your shoes. If you have $10,000 sitting in your savings account right now, in 1 year, that money will only buy you what $9,750 would buy you today. You didn't spend a dime, you were responsible, you saved. And you lost $250 of purchasing power. But it gets worse, so much worse, and this is where most people completely miss what's actually happening. Because that loss isn't a one-time thing. It compounds, it multiplies, it accelerates. After 5 years, your $10,000 hasn't just lost $250 times 5, it's lost over $1,200 in real purchasing power. After 10 years, you're looking at losing over 22% of your money's value. That $10,000 now buys what $7,800 would have bought you when you first put it in the account. You wake up every day, you check your balance, and it still says $10,000, so your brain tells you everything is fine. Everything is safe, but you've been robbed. Slowly, quietly, legally. And if you're sitting there thinking this can't be true, that the banks wouldn't do this to us, that someone would have warned us, I need you to do something for me right now. I need you to hit that like button because what I'm about to show you is going to change the way you think about money forever. And subscribe, because this is just the beginning of understanding how the financial system actually works versus how they tell you it works. The banks know exactly what they're doing. They're not stupid. They're not making mistakes. This is the entire business model. They take your money, they pay you basically nothing for it, and then they turn around and lend it out to other people at 5, 6, 7% interest. They're making massive profits off your money while paying you scraps, and the beautiful part of their scheme is that you thank them for it. You actually feel grateful that they're keeping your money safe. You feel responsible for having a savings account. Society has conditioned you to believe that having money in savings makes you smart, makes you financially responsible, makes you an adult, and all the while, you're funding their profit margins while your purchasing power evaporates. I learned this the hard way. I had about $15,000 sitting in a savings account for 3 years. I felt so proud of myself. I had an emergency fund. I was doing what all the personal finance gurus told me to do. Then one day I actually sat down and calculated what that money could buy me compared to when I first saved it. I felt sick. I had lost almost $1,400 in purchasing power, and my account balance looked exactly the same. Now here's where people start to panic, and I can already hear the comments. But where else am I supposed to put my money? I need it to be safe. I can't risk losing it in the stock market. And I get it. I really do. That fear is real. That fear is justified. But let me ask you something that's going to twist your brain a little bit. What's riskier? The possibility that you might lose money in an investment, or the absolute certainty that you are losing money right now in your savings account? Because that's what we're dealing with here. One is a possibility, the other is a guarantee. Every single day your money sits in that savings account earning nothing, you are guaranteed to lose purchasing power. The value of your money is guaranteed to go down. That's not a maybe. That's not a market crash scenario. That's just Tuesday. So when someone tells you they're keeping their money in savings because they don't want to take risks, what they're actually saying is they prefer the certainty of losing money slowly over the possibility of losing money quickly. And I understand that psychology. I really do. Slow losses don't feel like losses. They're invisible. They don't show up as a negative number on your statement. But let me show you exactly how invisible this really is, because this is where it gets genuinely disturbing. Imagine you put $20,000 into a savings account today. Fast forward 20 years. Your account still shows $20,000. Your brain sees that number and thinks you broke even. You didn't gain anything, but you didn't lose anything either. But in reality, with average inflation over those 20 years, that $20,000 now has the purchasing power of about $11,000. You lost $9,000. Almost half your money. Gone. Vanished into thin air. And your bank statement shows exactly the same number it showed 20 years ago. This is why your parents and grandparents constantly talk about how everything used to be so much cheaper. It's not that things got more expensive. It's that their money became worthless while they weren't paying attention. That house that cost $50,000 in the 70s, it didn't become worth $300,000 because it got better. The money became worth less. And if you think this doesn't apply to you because you're young, because you have time, because you'll figure it out later, you need to understand something right now. Every year you wait is a year you can never get back. So what's the solution? This is the part where I'm supposed to tell you to throw all your money into stocks, or crypto, or real estate, or some get-rich-quick scheme. But I'm not going to do that, because that's not how this works. That's not how any of this works. What I am going to tell you is that you need to understand the difference between saving and investing, and you need to understand it right now, today, before you lose another dollar to inflation. Saving is for short-term needs, it's for emergencies. It's for money you might need to access in the next 6 months to a year. And yes, for that money, a savings account is fine. You're going to lose a little purchasing power, but the trade-off is liquidity and safety. You can get that money immediately when you need it. But everything else, every dollar you don't need to touch for more than a year, needs to be working for you. It needs to be growing. It needs to be outpacing inflation at minimum. And this is where people get paralyzed. Because they don't know where to start. They don't understand investing. They're scared of losing everything. So they do nothing. And doing nothing is the most expensive decision you'll ever make. Let me break down what happens if you do literally the simplest possible thing instead of letting your money rot in a savings account. You take that same $10,000 and you put it into a basic index fund that tracks the stock market. Historically, over the long term, the stock market returns about 7 to 10% annually after inflation. Let's be conservative and say 7%. After 10 years, your $10,000 isn't $10,000 anymore. It's nearly $20,000. But wait, you're thinking, what about the risk? What if the market crashes? What if I lose everything? And those are valid questions that deserve real answers, not dismissive platitudes. Yes, the market goes up and down. Yes, there are crashes. Yes, there are years where you lose money. But here's the critical part that everyone misses. Over any 10-year period in the history of the stock market, even including the Great Depression, even including the 2008 financial crisis, even including every crash and panic and recession, the market has always recovered and gone higher. Always. If you have 10 years, history says you'll be fine. If you have 20 years, history says you'll do very well. But I know what you're thinking right now, because I thought the same thing when I first learned all this. You're thinking about that one person you know who lost everything in the stock market. Your uncle who day traded himself into bankruptcy. Your coworker who bought some random stock because someone on the internet said it would explode, and then it tanked. And yes, those stories are real. Those losses are real. But here's what nobody tells you about those stories. Those people weren't investing, they were gambling. There's a massive difference between buying a diversified index fund and holding it for decades versus trying to pick individual stocks and time the market. One is a proven wealth-building strategy that's made millions of regular people financially secure. The other is speculation that occasionally makes people rich, but usually just makes them poor. The issue isn't that the stock market is dangerous. The issue is that people treat it like a casino instead of treating it like what it actually is, a way to own small pieces of the entire economy as it grows over time. When you buy an index fund, you're not betting on one company. You're betting on capitalism itself. You're betting that businesses will continue to exist and make profits. And if you're still not convinced, if you're still thinking that keeping your money in savings is the safer option, I want you to answer this question honestly. What would hurt more? Watching your investment account drop by 20% during a market crash, knowing historically it will recover? Or realizing 20 years from now that you lost 50% of your money's purchasing power to inflation while it sat in a savings account earning nothing? Because both of those scenarios involve loss. Both of them involve watching your wealth decrease. The only difference is one of them recovers and grows. The other just keeps declining forever. One of them is temporary pain with long-term gain. The other is permanent, irreversible erosion. And here's the thing that really keeps me up at night, the thing that bothers me more than anything else about this whole situation. The people who can least afford to lose money to inflation are the ones who are most likely to keep everything in savings. The people who are living paycheck to paycheck, who finally manage to scrape together a few $1,000s, who feel like they're barely holding on. Those are the people who are told to keep it safe, keep it in savings, don't take risks. And those are the people who end up losing the most. Meanwhile, wealthy people understand this game. They know that cash is trash. They know that inflation is a silent killer. They keep only what they absolutely need in liquid savings, and everything else is invested in assets that grow. Real estate, stocks, bonds, businesses. Things that increase in value over time, or at minimum, keep pace with inflation. This is how the wealth gap gets wider. It's not just that rich people make more money. It's that they understand how to protect the money they have from inflation, while everyone else watches their purchasing power disappear. And the financial institutions love this arrangement. They love that regular people are scared of investing. They love that people think savings accounts are safe, because that fear keeps money flowing into banks at near zero interest rates, which the banks then use to make massive profits. It's a wealth transfer from the uninformed to the informed, from the scared to the educated. And it happens every single day, completely legally, right under everyone's noses. The system is working exactly as designed. It's just not designed to benefit you. So let's talk about what you actually need to do, because information without action is just entertainment. First, you need to figure out how much money you actually need in savings. And I mean truly need. Money for emergencies. Money you might need to access immediately if your car breaks down or you lose your job. Most financial experts recommend 3 to 6 months of living expenses. If your monthly expenses are $3,000, that means you need somewhere between $9,000 and $18,000 in actual savings. Everything beyond that number is just losing value. It's charity to your bank. Second, you need to open an investment account. This sounds complicated, but it's literally easier than ordering food on your phone. Most major brokerages let you open an account in about 10 minutes. You don't need thousands of dollars to start. You don't need to be rich. Some platforms let you start with as little as $1. Third, you need to buy a diversified index fund. Not individual stocks, not whatever crypto coin is trending on social media, not whatever your cousin's friend said is going to explode. A boring, simple, broad market index fund that owns tiny pieces of hundreds or thousands of companies. And then, here's the hardest part. The part where most people fail, the part that separates people who build wealth from people who stay broke. You need to do nothing. You need to leave it alone. You need to resist every urge to check it constantly, to panic when it goes down, to sell when you're scared, to buy when you're excited. You need to treat it like a plant that you water regularly and then ignore while it grows. Because the biggest enemy of investment returns isn't market crashes. It's human emotion. It's panic selling when things look bad. It's waiting on the sidelines when things look good. It's trying to time the market and getting it wrong over and over again. The people who make money in the stock market are the ones who buy and hold for decades, who automate their investments so they don't even think about it, who ignore the noise and trust the long-term trend. But none of this matters if you don't actually do it. And I know how easy it is to watch a video like this, nod along, think, yeah, I should really do that, and then do absolutely nothing. I know because I did that for years. I understood conceptually that savings accounts were losing money to inflation. I knew I should be investing. I had the information. But I didn't act on it because it felt overwhelming, because I didn't know which brokerage to choose, because I was scared of making the wrong decision, because there was always something more urgent demanding my attention. And every month I waited cost me money. Every year I procrastinated was a year of growth I could never get back. The market went up while my savings account stayed flat, and the worst part is I can't go back and fix it. I can't reclaim those lost years. I can only learn from them and move forward. So let me ask you something, and I want you to really think about this. If you still have all your money sitting in a savings account a year from now, will it be because you genuinely decided that was the best financial strategy for your situation? Or will it be because you procrastinated, because you got distracted, because you let fear or uncertainty keep you from taking action? Because here's what I know about most people. A year from now, they'll be in the exact same financial position they're in today, complaining about the same problems, stressed about the same lack of progress. And it's not because they don't want to improve. It's because they consume information without implementing it. They watch videos, they read articles, they nod along, they agree with everything, and then they close the browser and do nothing. And I get it, because changing your financial habits is uncomfortable. It requires admitting that what you've been doing isn't working. It requires learning new things. It requires taking action despite uncertainty. But you know what's more uncomfortable? Being 65 years old and realizing you could have retired 10 years earlier if you'd just started investing when you first learned about it. Being 40 and watching your friends buy houses and take vacations while you're still living paycheck to paycheck because your money never grew. Being 30 and seeing that your savings account balance looks exactly the same as it did when you were 25, except now it buys significantly less. That discomfort lasts forever. The discomfort of learning and taking action lasts maybe a few hours. You spend a few hours figuring out how to open an investment account, choosing an index fund, setting up automatic transfers. It feels awkward and uncertain. And then it's done. And then your money starts working for you instead of against you. Now I know some of you are thinking about objections. What if I need that money? What if there's an emergency? What if the market crashes right after I invest? These are important questions. So let's address them directly, because these fears keep more people poor than actual financial catastrophe ever has. If you need the money, you withdraw it. Yes, you might take a loss if the market is down at that moment. But remember, you are taking a guaranteed loss every single day it sat in savings. At least with investing, you have the chance of gains that outweigh occasional losses. As for market crashes, they're going to happen. That's not a question of if, it's a question of when. The market crashes periodically. It's dropped by 20, 30, even 50% during major crises. And every single time, people who panicked and sold lost money. People who held on and kept investing through the crash made fortunes. Because crashes are temporary. Inflation is permanent. A market crash is scary in the moment, but recoverable over time. Inflation is a slow, unstoppable erosion that never reverses. Which one is actually riskier? Here's what it comes down to. The fundamental truth that this entire conversation has been building toward. Your relationship with money will determine the quality of your entire life. Not just your bank balance, but your stress levels, your opportunities, your freedom, your choices. And right now, if you have significant money sitting in a savings account earning nothing, your relationship with money is based on fear and outdated information. You're making decisions based on what felt safe to your grandparents in a completely different economic environment. You're choosing the illusion of safety over the reality of growth. And every day you make that choice, you're betting that somehow, magically, your financial situation will improve without you changing anything. That's not how it works. Your money will not grow itself. Your savings account will not suddenly start paying enough interest to beat inflation. The system is not going to change to benefit you. The only thing that will change your financial future is you making different decisions starting today. Not tomorrow, not next month when you're less busy, not next year when you've done more research. Today. Right now. This moment. Because here's what I wish someone had told me 10 years ago. The best time to start investing was yesterday. The second best time is right now. Every moment you wait is a moment of growth you're giving up forever. Every dollar that sits in savings earning nothing is a dollar that could be multiplying. And 10 years from now, you're either going to wish you had started today, or you're going to be grateful that you did. So here's what I need you to do. If this video changed the way you think about money, if it made you realize you need to take action, hit that like button so other people can see this message. Subscribe to this channel, because we're going to keep talking about the financial truths that nobody else wants to tell you. And most importantly, leave a comment right now telling me what you're going to do differently. Are you going to finally open an investment account? Are you going to move money out of savings? Are you going to keep doing what you've been doing? Even if you disagree with everything I said, comment and tell me why. Tell me I'm wrong. Tell me your perspective. Because the conversation is how we all learn and grow. But whatever you do, don't just watch this video and do nothing. Your future self is counting on the decisions you make today.